it only serves. And I think the reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. That's a proper price. I don't care what that price is. It's the proper price.
Right.
It's not a COMEX-derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. Or many people have been gaslighted into believing that this huge COMEX volatility, because the January contract is already at par, shouldn't be. You've got backwardations in December, although the next liquid contract is March. But when you look at silver, then if you look January, that's already in technical backwardation. It is happening. It is happening already. And now we're talking about 2026.
Market veteran Andrew Maguire emphasized that the character of the precious metals market has fundamentally changed. The era of violent COMEX-driven sell-offs is fading, not because sentiment improved, but because the liquidity required to engineer those deep drops has evaporated. Physical demand has absorbed that liquidity, redirecting price discovery away from paper markets and into real metal exchanges. What we are seeing now is a more actual price, one built on immediate supply and demand conditions, not leveraged short-term speculation. Maguire notes that many still underestimate how significant this shift is, even as backwardation appears across near contracts, signaling structural tightness that is no longer theoretical. Silver and gold are quietly moving into a physical-led pricing regime, and the early signs of 2026's market dynamics are already forming beneath the surface. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Oh, completely different. And I think the difference is, again, pretty much what we've just discussed about gold. It's the same in silver. The real actors are gone. And I think this open interest that's in there, it's very limited as to what they can actually rinse out, because we've got physical markets being set in China. We work with the liquidity providers who interact with the Shanghai International Exchange, and really looking at what they're talking about. There's very little. It's interesting because I think what really sums it up, and you and I were talking about backwardations a little while ago. While we have unprecedented backwardations, we've seen $3 backwardations in the past. They get arbitraged one thing and another, but so close to first notice of the largest delivery contract of the year. We're seeing on last Friday, 60 cents, $3,000 per contract offside. Now we're still looking at 20, 30 cents. So what it tells us, what it screams at us is, hey, you can't have a backwardation coming into a delivery month where it's not telegraphing to you it's mispriced, severely mispriced. And I think the reason for that, Craig, is because the LPMCL's CME relationship, where they've got a footprint in both markets, haven't they? The liquidity spigot is broken. It's completely broken. They don't have liquidity anymore to be able to pull this back. And what you got, like 4 billion in SLV shorts. And some of that, yeah, there's going to be some legitimate hedging in there, but 4 billion in short positions. That means that if I own an SLV share, it isn't there necessarily, not if everyone wants it at the same time. And so I think it is screaming. I mean, to be honest, I think these guys are turning in on themselves. And like I said today in an episode, I think they're fighting like rats in a sack, trying to short cover these massive shortfalls because nobody is there to help you anymore. And literally, you can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80 because the January contract is already at par. Shouldn't be. I mean, so you've got backwardations in December, although the next liquid contract is March. But when you look at silver, sorry. So, but then if you look at January, that's already in technical backwardation. So it is happening. It is happening already. And now we're talking about 2026. I think silver is the Achilles heel of this same group of people. LPMCL are just the 4 banks that basically control the cartel, basically. And I think their liquidity is completely blown to smithereens. All the institutional guys, as we've just said, they've exited. And now you can still access as an institutional trader. I can then go in and tag the SGEI gold corridor, which is opening up big time. Can access an increasing number of vaults, gold and silver, that can be traded with a real physical price that is much more stable than this unbelievable paper toxic mix that is thrown in, and it only serves. And I think the reason that we're seeing less volatility, and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. And if I'm a producer or a refiner or something, why would I want a price that's so volatile? I just want to know supply demand. People are owning a bar before it's put for sale. You have to own it before you can sell it, which tells me that if you put it up for sale, that's a proper price. I don't care what that price is. It's the proper price. Right. It's not a COMEX-derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. That is how markets are supposed to trade. And we've been gaslighted, or many people have been gaslighted into believing that this huge COMEX volatility is the market. It just amazes me.
Andrew Maguire highlights how radically silver's structure has shifted now that fundamental physical markets dominate price discovery. The traditional liquidity used to drive COMEX volatility has evaporated, leaving legacy actors unable to force the deep sell-offs of the past. With backwardation appearing across multiple near-delivery contracts, the market is openly signaling mispricing and an underlying shortage that can no longer be hidden. Institutional liquidity has drained from Western paper markets and is increasingly flowing into Shanghai's physically anchored system, where supply and demand set a more actual price. As producers and refiners prefer stability over artificial swings, silver is quietly reclaiming a physical premium, revealing how broken the old liquidity channels have become. Let's get into the interview.
Then it tells us what the game is. The game is make sure, if I'm a seller, I'm UBS or JP Morgan, I've got silver at this price. I don't want to sell anybody, but I've got to look like I'm making a market. So make sure that Samsung, Nokia, and all these people get their silver, because if they don't get it in time, they're going to come to the market and just buy everything that they can, and the price is going to spike higher. Their derivative positions that relate to these. The reason they're not selling is because there's derivative positions attached to these physical bars, multi-leveraged. You know all about this. You've been talking about it for years with your clients. And it's like, well, of course, it's mispriced. So I think they can't actually, they've lost the plot. There is literally nothing they can do. They might want to do it, but there comes a point now where, it's just really interesting. I met a guy just a short while ago who's just written a book, I think 1,000 Reasons to Buy Silver. And he's saying, do you know that it takes 20 tons of silver to make 1 gigabyte? In photovoltaics, I say 20 tons of silver to make 1 gigabyte. And he said thousands of gigabytes are required. He said, so there's a supply shortage.
Wow.
And now we've got another 500,000 ounces a year of stuff that doesn't include AI. I mean, where's this silver going to come from?
Right.
These guys have dug a hole for themselves. It's a multi-billion-dollar hole. There isn't the silver there to fix that hole. The market's just simply going to run off with the SGEs are going to set the price. So if you have a mispriced position and it just happens to be a little bit backwardated at the moment, what happens when it is $3, $5, $10 difference and permanent? What happens to the COMEX then? Well, I think as far as gold's concerned, you've got two for all the reasons that you've just said. What if there was a black swan event? What if there are cockroaches running around? So if institutional buyers are in there, and I mean, forget everyone else in Asia who views it differently to people in the West have, but need that exposure, then obviously, as far as gold's concerned, then they've still got to allocate more and more and more. Price is inelastic. It doesn't matter. They're just going to dump more dollars and get that exposure, because we'll go out of risk into cash and into gold. So that demand there is competing with Asian demand, and it's setting a physical price. So I can't see. I honestly believe $8,000 gold. People say, "Oh, how can you get?" Well, okay. Well, we figured 4,500 gold by the end of this year, and that was only at it was 2,900 or whatever it was. I
Yeah.
mean, you start breaking some of these barriers and the race starts to really accelerate. Now, as far as silver's concerned, how? I mean, we've already talking about a supply deficit. Now you're talking about the AI boom. So even if there's a slowdown, you have to look at the market. As overvalued as it may be, AI is going to require a lot of silver.
Andrew Maguire shows just how distorted the Western silver market has become. Sellers linked to major banks appear more focused on protecting complex derivative exposures than on allowing true price discovery, ensuring industrial giants receive metal quietly to avoid a panic rush into the open market. At the same time, structural shortages are intensifying as demand for photovoltaics, AI, and global manufacturing swallows millions of ounces that cannot be replaced. With supply constrained and backwardation widening, pricing power is shifting toward the Shanghai physical market, where real bars and real delivery now set the tone. As gold accelerates beyond key thresholds and silver's industrial pull collides with shrinking availability, the system that suppressed prices for decades is losing control. A much higher physical revaluation is becoming unavoidable. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.